Financial statement fraud is the deliberate over-understatement of financial statement balances in many cases to make a company appear to be in better financial condition than it really is to deceive a financial statement user. Classifications. The 5 classifications of financial statement fraud are fictitious revenues, timing differences, improper asset valuations, concealed liabilities and expenses, and improper disclosures. Fictitious revenues are when people inflate a company's profits by recording revenues for goods and/or services that were never delivered. Timing differences are playing with the period in which revenue or expenses fall in order to improve the perceived financial position. Improper asset valuations are recording assets at a number that would improve the perceived financial position. Concealed liabilities and expenses are when people hide or disguise the company's obligations. Improper disclosures are when information is not shown on the disclosures of financial statements in order to hide unsavory information. Examples: fictitious revenues, example Luckin Coffee. From at least April 2019 through January 2020, Luckin intentionally fabricated more than $300 million in retail sales by using related parties to create false sales transactions through 3 separate purchasing schemes. According to the complaint, certain Luckin employees attempted to conceal the fraud by inflating the company's expenses by more than $190 million, creating a fake operations database, and altering accounting and bank records to reflect the false sales. First fraudulent scheme, individual coupons. In April 2019, Luckin began fabricating the number of coupons sold and redeemed by individual customers. Some of Luckin's employees, their family members, and other related companies transferred money from private bank accounts to their WeChat Pay or Alipay accounts in order to purchase coupons on Luckin's app. They then redeemed the coupons and created fake orders, thereby intentionally and dishonestly increasing sales figures. More than $1 million of sales was fabricated in the first scheme. It is uncertain whether Luckin recycled the money back to the employees so they could purchase more coupons. However, Luckin recognized the fabricated revenue. Second fraudulent scheme, corporate coupons. In May 2019, Luckin employees began selling coupons to fake corporate customers who were in fact related to Luckin employees. The corporate customers would transfer money from their corporate WeChat Pay or Alipay accounts to Luckin's app to buy coupons. Similar to the first scheme, these fake coupon redemption orders artificially enhance sales performance. Roughly $10 million of sales were fabricated in the second scheme. However, it is uncertain whether Luckin recycled the money back to the employees. Third fraudulent scheme, shell coupons. Beginning in May 2019, the third scheme saw Luckin employees fabricate the number of coupons sold to third-party shell companies. These shell companies would then resell the coupons to individual customers. It is likely these individual customers were also employees, as they neither placed real orders nor redeemed the coupons. Some of Luckin's employees or their related companies established and controlled these shell companies, which transferred funds to Luckin. Employees would then change the name of the sender from the funding company to the shell company in Luckin's bank statements. Luckin's employees would redeem coupons and make fake orders, fabricating coupon sales and revenue. This made up the largest portion of fabricated revenue, approximately 90% of the total $311 million. Some Luckin employees switched the source data from the actual business operations database to the fabricated database. Source data includes reports necessary for preparing financial statements and bookkeeping. Luckin's finance department could only access the fabricated database and thus failed to notice the abnormal transactions. Fabricated expenses and returned funds. Luckin returned funds to the funding companies in the third scheme through bank transfers and fabricated expenditure. Business-related expenses, as set out in the financial statements, showed that there were payments to vendors, including suppliers. However, these vendors did not provide any services or products to Luckin in return. Luckin also fabricated costs so that they were consistent with the overstated revenue. In 2019, the total fabricated expenses and costs were around $196 million. ACFE fictitious revenues data analytics tests. Compare discounts or incentives on a monthly basis to identify unusual spikes at the end of the quarter or year. Identify revenue recognized at period end and subsequently reversed or partially reversed. Analyze gross margin by month and identify any outliers. Analyze sales to customers that have company names that sound like known customers and have missing fields. Analyze the emails of selected employees, accounting or sales, for revenue recognition-related keywords indicating incentive, pressure, opportunity, and rationalization. Additional fictitious revenues data analytics tests compare vendor purchases and customer sales lists. Analyze location sales, hash of customers, and COGS for discrepancies. Timing differences example, Revolution Lighting. According to the SEC's complaint from late 2014 to mid-2018, Revolution Lighting improperly recognized revenue for sales much earlier than permitted by accounting rules or the firm's own written revenue recognition policies. The complaint alleges that as Revolution Lighting approached the end of each fiscal quarter, La Penta and De Palma pressured Garner, O'Neill, and sales personnel to improperly record anticipated future sales as current bill and hold sales to make up for revenue shortfalls. The company then allegedly recognized revenue from the uncompleted sales. On multiple occasions, Garner allegedly concealed this practice by providing backdated documents related to bill and hold sales to the company's auditor. As alleged, De Palma kept careful track of Revolution Lighting's reporting of bill and hold transactions through a bill and hold schedule that Garner and later O'Neill prepared. The complaint alleges that the defendants failed to disclose that bill and hold sales represented a significant portion of Revolution Lighting's revenue, or that the company was materially deviating from its stated revenue recognition policies. Timing differences. Data analytics tests analyze gross margin by month and identify any outliers. Compare invoice dates to shipping dates for large gaps in time or shipping date prior to invoice date. Compare incoming invoice dates to goods receipt dates for large gaps in time or shipping date prior to invoice date. Check any unusual revenue entries not supported by documents. Conduct a Benford's Law analysis to identify anomalies such as disproportionate number of invoices starting with specific numbers. Improper asset valuation example. Hertz, according to the SEC's order, from February 2012 through March 2014, Hertz's public filings materially misstated pre-tax income because of accounting errors made in a number of business units over multiple reporting periods. In July 2015, Hertz restated its financial results for prior periods, identifying $235 million in previously reported pre-tax income based on treatment of items that was not consistent with generally accepted accounting principles, GAAP. The SEC's order finds that the inaccurate reporting occurred in a pressured corporate environment that placed improper emphasis on meeting internal budgets, business plans, and earnings estimates. For example, according to the SEC's order, improper methodologies were used to determine allowances and write-offs for aged receivables. On several occasions, the methodologies were changed, always with a favorable impact on the financial statements. In one such instance in the fall of 2013, in the midst of severe budget pressure, the methodology was reworked so that some categories of receivables were reserved at an effective rate of 4%, implying a 96% recovery rate that was substantially above historical recovery rates. Improper asset valuations. Data analytics tests. Review sales of fixed assets for prices significantly below or above depreciated value. Identify sales of fixed assets significantly before end of depreciation life cycle. Review number of unplanned write-offs of assets that could indicate systematic issue in setting up depreciations. Isolate stock where cost is greater than retail price. Identify surplus or obsolete inventory. Concealed liabilities and expenses data analytics tests. Compare and/or stratify expenses by month and to prior year, and investigate outliers. Analyze expenses after significant cutoff dates to identify any delayed records. Analyze time of invoice to payment and identify invoices with unexpectedly short times between invoice and payment. Improper disclosures. Data analytics tests compare subsequent events to prior year subsequent events. Compare related party transactions to third-party transactions and reconcile to disclosure information.